Views regarding the economy, securities markets, or other specialized areas, like all predictors of future events, cannot be guaranteed to be accurate and may result in economic loss to the investor. Past performance is no guarantee of future performance. Any information is for illustrative purposes only and is not intended to serve as investment advice or as a recommendation, since the availability and effectiveness of any strategy is dependent upon your individual facts and circumstances. Individual securities discussed may be held in accounts where JGUA and or its employees have a beneficial interest. And with that, let's get to this week's episode.
Hey everybody, Dr. B here with John G. Ullman and Associates. This is our weekly market update for the week of June 2nd. Thank you for joining us this week. As always, if you enjoy the content and find it informative, don't forget to like the video and subscribe to the channel. And if you've got a couple minutes, check out some of the other great content we put out here on the channel. With that said, thank you for joining us. Hopefully you'll find this video informative. And as always, our goal is to use my background in economics to help you better understand the economy and the financial markets so you can make informed financial decisions. So with that in mind, let's get ready to hit the books and get up to speed on the markets. So as usual, we'll start by taking a look back at last week. One of the big headlines for last week, surprisingly, had to do with tariffs. The U.S. Court of International Trade decided that the Trump administration had overstepped their bounds and their authority in the implementation of a significant amount of the Trump trade tariff policy and actually stopped the tariffs and called for some refunds to tariffs that have already been paid. The next day, the appeals court decided that the case needed to be given time to be appealed and completed before any changes could be made, so they paused the order of the lower court. And we now move into June with more questions about potential tariffs, changes in the future, and the legality of the tariffs that have already been declared. Also last week, we saw our weekly unemployment insurance claims data come through. Unfortunately, we saw the initial claims jump to the highest point in the last 5 weeks, and we saw continuing claims rise to the highest level since November of 2021. Now, some analysts started looking at the data and suggested that this may be more a function of the academic school year ending and less a function of any damage or harm being caused by the Trump tariffs. So the big question is, for the next few weeks moving forwards, are we seeing a new trend unfolding, or is this a temporary one-time blip? Also last week, we saw the first revision to the initial estimate of the first quarter gross domestic product for 2025. First quarter GDP had originally come in as a 0.3% contraction or shrinking in the GDP. This revision changed that to 0.2%. Ultimately, with the addition of new and updated data, we saw consumption values fall more, but we saw that offset in addition by additional investments and additional government spending. We also saw data on inflation as the April Personal Consumption Expenditure Price Index data was released. We saw the inflation data for April come in a little softer than had been expected. We saw the 12-month inflation rate drop from 2.3 to 2.1%. And for the core data, we saw it drop from 2.6 to 2.5%. Now, although this is positive information, and certainly something that surprised markets in a good way, we also saw that the month-over-month data showed a slight increase in the rate of inflation, with both the core and the headline values increasing by 0.1%. In the same report, we also saw personal income increase significantly in the month of April, and personal consumption or personal expenditure increased by a small amount, significantly less than the historical average. In fact, when we dig into the personal expenditure, how are consumers and companies spending money, what we saw was increased spending on housing, utilities, and healthcare, as well as services in general, while at the same time observing decreased spending on consumer goods. To wrap up the economic data from last week, we saw reports from the Conference Board on Consumer Confidence and from the University of Michigan on consumer sentiment. Both of these survey results demonstrated a softening or a reduction in pessimism among consumers during the month of May. Both demonstrated a slight improvement from their lows in the month of April, and ultimately conveyed in one fashion or another that consumers saw the rebound in the stock market up to this point and the reduction of trade conflict with China, the European Union, and several other countries as a positive note for today as well as future expectations. Although the majority of these reports were mostly positive, there was still some ongoing concern about inflation and ongoing concern about current labor market and future labor market conditions, given the uncertainty and the unknowns in trade policy in the future. Turning our attention now to earnings reports, we're still seeing a few first quarter earnings reports trickling in during the week. Last week, the big headline was Nvidia, which happens to be one of the largest companies in the United States as well as the world. They reported strong earnings and strong revenues and an optimistic perspective on the future, although they did explicitly mention the potential for harm that could result from ongoing tariffs and trade wars. They also reported that their data center sales increased 73% and their revenues in the first quarter increased 69%. In addition to Nvidia, we also saw earnings reports from several other companies, including clothing retailers Gap and Macy's. The Gap, in their earnings reports, explicitly mentioned the fact that ongoing tariffs and trade wars could ultimately cost them as much as $100 to $150 million. Macy's, at the same time, mentioned that they intend to raise prices and most likely stop carrying certain lines of products as a direct result of the financial impact of tariffs on their business. Turning our attention to the stock market, we saw stocks rise early Tuesday morning as a direct result of President Trump backing down on the 50% tariffs he had threatened to place on the European Union. And later in the week, in a related issue, we were introduced to the term taco trade. Taco, T-A-C-O, stands for Trump, always chickens out. Ultimately, this term was thrown around as justification for why stock markets continue to recover and continue to grow in spite of the ongoing uncertainty and in spite of the ongoing repeated threats of President Trump and his administration against major U.S. trading partners. The week for the stock market saw slight gains at certain points during the week, slight drops at certain points during the week, but ultimately we ended last week with all three major indices up just under 1%. Turning our attention to the fixed income side of the markets, we saw the yield on the 10-year Treasury increase early in the week, reaching above 4.5% at one point, before ultimately falling back down towards 4.4% at the close. We also saw a little bit of volatility in the Bitcoin market as Bitcoin prices rose early and then ultimately fell off later in the week, ending the week down a few percentage points at about $105,000 a coin. We saw the market for crude oil and the market for gold both drop throughout the week. Crude oil ending the week down about 2%, and the market for gold dropping about 1%. In addition, we saw the market for the US dollar ultimately flat, although there was a slight increase followed by a slight decrease around the middle of the week. The value of the US dollar ended the week about where it started. Turning our attention to this week ahead, this will actually be a relatively quiet week as far as earnings reports are concerned, the main headliner being tech giant Broadcom, but the majority of focus this week will be on jobs. We're actually entering into our typical weekly job reporting week, with Wednesday, the ADP private employment report being released, Thursday, our weekly unemployment insurance claims being released, and Friday, our much awaited national unemployment report for the month of May being released. With this in mind, a lot of attention will be on these jobs reports. Right now, one of the theories as to why the impact of tariffs has been relatively small and hasn't necessarily propagated through the larger economy is the ongoing strength of the labor market. Every month, we land in this place where we're, of course, curious, will the labor market continue to be strong? Will employers continue to wait to hire and wait to fire? Or will we start to see indications of cracks and shifts as far as labor market policy and approach is concerned? Wrapping up this week, we'll see economic reports on consumer credit, construction spending, and factory orders. Now, although these reports are much smaller and for the most part tend to align well with expectations, the big question is whether that will continue as the effect of tariffs and trade policy filters through the economy. Looking ahead, a little further into the future, of course, the buzzword continues to be uncertainty. In spite of all the uncertainty and the potential for disruption in the future, what we're seeing across most markets is, in fact, a generally positive attitude. In the soft data and the survey data last week, we saw that consumers have potentially moved out of panic mode and into apprehensive monitoring mode, watching to see what actually takes place. And in the hard data, we continue to see a relatively strong economy chugging forward month after month. So with this in mind, the big question, of course, looking to the future, is what will future disruptions be, and will they be enough to shake the confidence one more time of the markets, of the consumers, or to actually start to have a negative impact on the hard data? Without that, it's possible that the economy continues to chug along slower than the previous 2 years, but at a healthy pace with a substantial amount of growth. Unfortunately, only time will tell. With all this in mind, we're glad that you continue to come back and join us for these weekly market updates. As always, we'll continue to do our best to read through all the economic data, the reports, the analysis, and bring you the most important information in an easy-to-understand format so that you can stay up to speed on the markets. Don't forget to join us again next week. Also, don't forget to throw any questions or thoughts you may have in the comments. We'll respond and potentially include it in the next video. Thanks again, and good luck.
Thanks for watching. If you found this video helpful, give it a thumbs up and hit that subscribe button so you don't miss future updates. Looking for more insights like this? Head over to our website at jgua.com for additional resources. And if you'd like to talk about your personal financial goals, we'd love to help. Just click the Schedule a Meeting button highlighted on your screen to book your complimentary consultation. Thanks again for joining us. We'll see you in the next video.